I guess it's been clear right since the beginning that although there's something in common among there's something in common in what people in different places use as money these days. It's all fiat money. At the same time, the fiat money that we have here isn't very useful for buying or selling goods in, let's say, Japan. So, as a result, there are many different kinds of money around, but every now and then you might need, for some reason, to transact with someone in Japan or in Japanese currency. And so there's this market for currency exchange where the money that's used in one place is swapped for another one. But before that, as I mentioned, I do want to wrap up our discussion of derivatives and options in particular. And to do that, please go to Blackboard and under exams should find a document called Options Worksheet, which is this. So please go there and open up the Options Worksheet. And in a minute, once I've explained what this worksheet is, I'll put you in breakout rooms so you can work on it in groups of 3 or so. What it's going to do is the following. There are the one thing that we haven't really discussed, we only discussed it broadly, is what is it that determines how much you would want to pay for an option. And that's what this whole thing is about. So the setup for this problem is the following. So imagine there is a call option. Remember, a call option is the right to buy a stock next year. And the strike price is 1,000. So you have the right to buy, but not the obligation to buy the thing for 1,000 next year. Now, there are 2 possible things that might happen next year. One is that there's a 50% chance that the price of the underlying asset, that stock, would be 1,220. And there is a 50% chance that the price of that stock is 780. So with that setup, whoops, just a second. I have some notes here that I need to remove. So the first question is, what is your expected profit from owning this option? So ignoring how much you paid, just like we did on Monday, just think about if you had the option when next year rolls around, how much would you profit from it in expected terms? And second, what is the present value of that? Right? And question 2 says, if people are risk neutral, what does this tell you about the price of the option today, or the premium? And question 3 is going to ask you to do the exact same thing, except that instead of the prices being 1,220 and 780, the 2 possible prices are moved further apart. So the possible gain is much larger, and the possible loss is also much larger. So I'm going to interpret that as an environment with increased volatility or increased uncertainty. Then you're going to do the same thing, and then there are a few more slides after this, which is to help you think about the factors that determine what the premium is for a given option. Okay, so open that file, and let's see. There are enough students here to make each group have exactly 3 people. So I'll put you into breakout rooms now so you can work on the options worksheets, and then I'll come back in 5 or 6 minutes or so. Okay? All right, ready, steady, go. So question 1, what was the expected profit from owning the option? Any volunteers? Let's see. So the first part is saying what is the expected profit from the option, And well, in one case, the asset price is 220, so it's a call option. You have the right to buy for 1,000 and sell it for 1,220, so that would be your benefit. Of course, that only happens with probability half. In the other case, you buy it for 1,000 and sell it for 780. Someone's having sound issues with probability 5, but what's wrong with this? What's wrong with this, of course, is that that's a negative number and you have the right, not the obligation to do it. So you wouldn't do it. You would just lose money if you did that. And so the expected profit is only this, which is 220 over 2, which is 110, right? And then the present value of this is 110 over 1 plus the interest rate, which is 0.1, which is 100. Very good. So that's the first part. Then the second part says, if people are risk neutral, what will be the price of the option today? What do you think? If people are all risk neutral, then of course the premium, the amount that you would want to pay for this asset would be, of course, precisely this present value. Anything different would open up the possibility of arbitrage opportunities. What about question 3? Did you all get to question 3? Or did any of you get stuck earlier? Who wants to volunteer the answer for question 3? You got stuck earlier? Okay. Yeah, I wasn't sure how much time would be right to leave. Of course, the way we approach it, Marshall says 165. So let's go to the first part. And it's the same procedure as before, right? If the price ends up being high, it's 1330 minus 1,000 divided times the probability of 0.5. Again, plus what happens if the price is low, but as discussed, if the price is low, you don't want to exercise this option because it's negative. So the answer is just this. And that's 165. Correct, Marshall? And then what's the present value? It's 165 as before divided by 1.1. And you'll notice that 165 is 150 plus 15. And 15 is 150 times 0.1. So this is just 150 times 1.1 over 1.1. Or you can just do this with a calculator, which of course is, sorry, I made a typo there. Oh, no, I didn't. That's correct, which is just 150. So with increased volatility, what do we get? We get that this asset is worth more, this option.
So is the premium?
Yes, Marshall.
Is the premium in this case 15? Is it how you understand it?
No, it's 150. It's just what people would be paying for it, and if they're risk neutral, then they're just willing to pay whatever they expect to get out of it.
All right.
So it's gone from 100 to 150 when there's more volatility. So this next sheet says, does volatility make call options more or less valuable? And remember, the downside risk doesn't matter to these risk neutral people, right? It's erased by the option, by the strike price, and so it doesn't matter. But on the other hand, the upside, when there's more volatility, is much greater, right? Instead of getting a present value of, or expected present value of 100, it's 150. Just because there's more uncertainty. Now, on the other hand, this is all with risk neutral people, right? If you were not risk neutral, if you're risk averse, like we believe most people are, then there would be an additional reason why the option might be more valuable in times of uncertainty. That's because avoiding that downside is much more valuable for you if you're risk averse. So there would be two reasons. Now, did anyone get to question 5? I'm guessing if not everyone made it to 3, then not everyone made it to 5 either. 5 is the same, and in the sense that it's the same. It's also the case that the put option is going to be more valuable in times of greater uncertainty. And the reason is, let's see, suppose in the case of the put option, it's the right to sell the share at a certain price. So in order to sell it, you have to buy it. So in one case, you sell it for 1,000. You had to buy it for 1,220, and that happens to probably 0.5. But again, why lose money? You don't have to sell at that price. You don't have to exercise this option. So that would be times 0, because you just don't do anything in that event. The other one, you get to sell it for 1,000. You get to buy it for 780. That happens with probability 5. In that case, you would exercise the option, and you'll see that it's the same. It's the same because I rigged. I picked numbers that way. Whoops. Sorry, I made a mistake there. That's a mistake. It just won't let me edit it. Anyway, let me see if I can. No, it won't let me edit it. So there's a typo here. It's not letting me change it, but this should be just 220 divided by 2, which is 110 as before. And then the present value is 110 over 1.1, same as before, which is 100. And by the same token, when there's more volatility, this one is also going to be more valuable. It's a different set of events that create the profits, but when there's more volatility, it still increases that upside and also makes the risk of avoiding the downside more valuable. And so this is one thing that options allow you to do that you wouldn't be able to do with other assets, and that's to be able to bet essentially on the amount of volatility that you expect there to be in the economy. If you think that if things are very volatile, options suddenly become more valuable. If things are safe and predictable, the options are not very valuable. And that's pretty neat. In fact, there is this that suggests that option prices might be a way of trying to actually measure uncertainty. And indeed, that is the case. There is this indicator called VIX, which just stands for Volatility Index, which is made out of, which is a collection. It's an index based on the collection of options prices. And it tends to go up when, in times of uncertainty, as you can see, here is 2008. You can see that the VIX spikes. Here it spikes again in 2010. There's a massive spike here in early 2020. We know why that happened. It almost looks like there's kind of like some baseline level of uncertainty with occasional spikes, which I think is kind of interesting as well. It means there's sort of like some background uncertainty that's always there, and then there are occasional times when suddenly people are much less sure of where things are going to go. That's called VIX. And again, why it's used as an indicator of uncertainty? Well, we just discussed it. In times of uncertainty, options are more valuable because the upside that you could get some profit becomes greater, and the downside risk of things not working out also is cut off, and thus that becomes more valuable as well. Any questions, thoughts, comments about options and volatility? If not, yes, Marshall.
I mean, it doesn't sound good. You know, it seems like people are profiting off, volatility.
Are they profiting off it? Well, I mean, again, it's remember that the options are sort of like, I mean, reason their prices are called premia is because they're sort of like insurance contracts. They're allowing you to avoid certain kinds of risk. Of course, again, remember, if someone sells you an option, they're assuming for themselves the downside risk, right? If things work out so that you profit from having the option, the person that sold it to you is going to lose. But again, that's fine. Some institutions, like large banks, maybe are better able to bear a risk. And so what they're doing is and by having options contracts, as you say, one can use them to make bets. But the flip side is that someone is also using them to try and deal with risk. So they're both aspects to all these derivatives. Any other thoughts, comments, doubts? If not, then our next order of business is to switch gears and talk about a new topic, which is the topic of exchange rates and how figuring out how it is that the markets for different currencies work, and I guess remembering that this is a course in economic theory, the most important thing that we're going to want to do is to see if we can develop a theory or a set of theories for how it is that exchange rates are determined. Now, there's one issue here, which is that suppose I tell you that that $1 will buy you, let's say, 100 yen. That's a statement of the exchange rate, right? If you give me $1, I'll give you 100 yen. And if you give me 100 yen, I'll give you $1. So it's clear what that means. On the other hand, what if I tell you the exchange rate rose today? Okay. Which one does it mean? Does it mean that the dollar gained value relative to the yen? Does it mean that the yen gained value relative to the dollar? We're going to need a convention for that because I guess the textbook has a convention. So when you read the textbook, they're defining the exchange rates, which in algebraic terms they call ET, where T is indicating the date, is the amount of foreign currency per US dollar. So they've taken the US as the benchmark location. Hey, Michigan is American. He lives in New York, so I guess that's fine. Exchange rate. So we're taking the US as the benchmark place, and then the exchange rate is the amount of foreign currency per dollar. So if the exchange rate rises, it means the dollar buys more yen, which of course means the dollar has gained value. Okay? So that's how we're going to define exchange rates in general. Next, it turns out that the way foreign exchange markets are set up varies from place to place and over time, I guess. So we're first going to talk about how market forces shape exchange rates. And so we're going to assume that the exchange rate market is basically free from regulation or government intervention. We're going to refer to that situation as the exchange rate or the foreign exchange market being flexible. And this situation is sometimes also referred to as a float. So it's a floating exchange rate, rises and falls with market forces. As opposed to what? Well, in some countries, in some periods, the exchange rate has actually been fixed by government fiat. And more generally, you may have heard from the news that there's discussions about governments trying to intervene to make currencies gain or lose value. which is neither flexible nor fixed, right? It's somewhere in between. So we're going to first talk about flexible exchange rates so we can understand how market forces shape them. Then we're going to think about, given that, how might governments try and fix exchange rates? And when we've looked at these two polar opposites, we'll be able to understand all the spectrum in between. I should say that, in general, attempts to fix exchange rates tend to fail. I guess we'll come back to that later when we reach that point in the class. For example, when I was growing up in Peru, there was a fixed exchange rate at some point, but there was a street. Well, okay, let me back up. The problem is they fixed the exchange rate, a rate that was very different from what the market would have done. And there was very high inflation. And so a lot of people would prefer to hold dollars than the local currency because the dollars were more stable. And the value of the dollar was more stable. And in Peru, there are a lot of dollars because Peru is a major producer of cocaine. And so there are all these dollars sloshing around anyway, since cocaine is largely like oil, is largely a dollar-denominated business. So there was this street in Lima, Gironocoña, and you could go there. There'd be these guys standing around with calculators in their hands. And you just drive up to them, roll down their window, and they would shove a calculator in with a number, which was the exchange rate that they would give you. And if you liked it, you'd give them a wad of whatever currency you wanted, and they'd give you back the other one. You had to count it carefully because they like to cheat you, since this is a black market, of course. That's it. And so that attempt to fix, again, was something that people would try to get around. Again, if it's fixed at a value that doesn't bear much relation to what market forces would have dictated, so to speak. But anyway, we'll talk about floating rates, we'll talk about fixed rates, and then that'll help us learn about everything in between. Okay? Great. And I hope you never experienced the kind of inflation rates I did growing up. We'll come back to that in a second, actually. Now, another thing about foreign exchange markets that needs to be pointed out is that it turns out that in the foreign exchange market, there is a huge amount of forward or futures transactions. So we're going to want to distinguish between the spot rate, which is the exchange rate right now for a transaction that's occurring right now, as opposed to the forward or futures rate. It's usually referred to as a forward rate. So we're going to be talking about spots, but again, we know about futures. The futures prices are determined by what you expect the exchange rate to be at the future date. A little more terminology, and then we'll get to thinking about economics. There are special words to refer to exchange rates rising and falling. When a currency gains value due to market forces, you say that the currency has appreciated. And when it declines due to market forces, you say that the currency has depreciated. All right? Now, notice that I said due to market forces, because of course, it turns out that there is different terminology to refer to changes in the value of fixed rates. You might say, well, if the rate is fixed, why would it change? Isn't that a contradiction? And the answer is, well, sometimes governments who had fixed rates might decide to change the rate at which it's fixed, one way or the other. And so for fixed rates, if the government decides to change it, we instead talk about revaluations which is when the government raises the value of the currency by fiat, as opposed to devaluations. So these terms may be used interchangeably, depreciation and devaluation. I don't mind personally, but do keep in mind that they are supposed to be used for different contexts, just to avoid confusion. Okay? Great. So now that we have some terminology out of the way, the question is, why would I need some foreign currency? Let's say, continue with the same example, Japanese yen. This is the symbol. So what reasons might I have, even though I live here in the United States, to want to acquire Japanese yen? Any ideas? In the other section, yes, you plan to travel there, you're going on vacation. Okay. That's one. Any other ideas? So if you're traveling there or going on vacation, the way we tend to think of that is as though you had imported hoteling services or tourism services. So the broader idea that you're getting in when you're planning to travel there, whether it's on vacation or for any other reason, is that you're trying to buy Japanese goods and services. So that's one reason. It's because you want to try Japanese goods or services. Whether because you're flying there or because you're trying to import them to the United States. Any other possibilities? Other reasons why you might want to buy Japanese currency? Sophia mentioned something about inflation. We'll get to that very soon, actually. So set that thought aside for a second. Goods and services aren't the only things that we buy, right? Another thing that we've been discussing throughout the semester, throughout the semester we've been discussing buying and selling things, but they weren't goods and services, right? What were they, for example? Well, broadly, securities, exactly. This whole course, assets of various kinds, precisely. So the other reason why you might be buying Japanese currency is because, excuse me, you're trying to buy Japanese bonds, or maybe you're trying to buy Japanese shares. So we'll start with this and see what that tells us about how exchange rates might behave. Then when we're done with that, we'll move on to see what this tells us about exchange rates, and finally we'll go there. Okay, so let me save this. In case we need to get back to it. So let's focus on goods and services and what that tells us about exchange rates. So let's think of an example of a good that you might be able to bring over from Japan. And let's think of a good that not only could you bring it over from Japan, but it's also something that you could get here. Let's see, a major international market where the United States and Japan both produce things is autos. Exactly, Marshall is exactly on the same wavelength. And let's just pick an auto that you can buy either made in the United States or made in Japan. Let's just say Honda Civic. It's a kind of car. Honda has plants in the United States. Honda has plants in Japan, so you could buy either one. Now, if you were a dealer, a car dealer who sells Hondas, of course, you would want to buy Hondas wherever they're cheaper, right? So let's write down what are the prices of the two Hondas. There's a Honda that you can buy in the US, and let's say if you're a dealer, it costs you 10,000. On the other hand, the cost of the same Honda Civic in Japan is, let's say, 1 million yen. Which one is cheaper? The answer is impossible to tell, right? You could not tell which one is cheaper unless you also knew the exchange rates. So let's suppose first of all that, let's just pick an exchange rate. $1 equals 100 yen. Which one is cheaper now? Well, to figure that out, let's take the US dollars, it's 10,000, and see how many yen that corresponds to. Multiply it by 100, and what do we get? We get 1 million. So if that happens to be the exchange rate, then they're the same. On the other hand, what if, suppose $1 is more than 100 yen? Then if I multiplied my 10,000 by this exchange rate, I would get more than 1 million. So that means in this case, the US car is more expensive. And I want to source my cars from Japan. Similarly, suppose $1 is less than 100 yen. Then the US car would be cheaper. The Japanese car would be more expensive. Because $10,000 would be less than 1 million. And then I would want to source my cars from the US. Well, now what does that tell us about actual exchange rates? Suppose we're in this situation where the US car is more expensive. Then I want to source my cars from Japan, which means what? It means I need to buy Japanese currency in order to buy the Japanese cars. If I buy lots of Japanese currency because the US cars are expensive and the Japanese ones are cheaper, what is that going to do to the exchange rate? I'm suddenly buying the Japanese currency. It means that it's raising the value of the yen or lowering the value of the dollar. So that means that the difference between 100 and the exchange rate is shrinking. In other words, if the US car is more expensive, the yen gains value and it's moving us in the direction of that exchange rate. Similarly, if we're in this other situation, the Japanese car is expensive, we wouldn't want to buy as much yen, which means that it would lose value, or the dollar gains value. Of course, what that means also is that this change is taking us back towards that situation. So this idea, which essentially is saying that the costs of goods should be about the same everywhere, and rather to be precise, that the exchange rate should adjust to make sure the costs of goods are about the same everywhere. This is called Purchasing Power Parity, or PPP. So that's a prediction of this idea of considering how you would, considering sourcing things from different places. Now, you might think, well, we're talking about a particular good here. And is it true that the pricing of price imbalances in a particular good could drive exchange rates? Probably not, unless that good, as discussed, is a major part of trade between these countries. But certainly, what if there are major imbalance in prices across all goods? Well, then we would expect something like this to occur. Now, again, calling it PPP for short, if you think about it intuitively, there might be some reasons why PPP doesn't hold. One reason is, well, why would you go on vacation in Japan? Because it's different, right? There are things that are there that you can't get here. Broadly speaking, I guess one way of putting that is that not everything is tradable, right? There are things in Japan you can't just move around. Japanese land, for example, you can't ship that abroad. And so those things would, I mean, a thing that isn't available in both places doesn't really follow this argument very well. Another thing, even if we focus on cars and Honda Civics, is if you were a dealer here based in the United States, assuming you're in the United States, and you were choosing whether to source the cars from the United States or Japan, if you brought it from Japan, you wouldn't just have to pay the million yen for the car. You also have to pay for putting that car onto a ship and sailing it across the ocean and through the Panama Canal and up to the port in Baltimore. And that's expensive. And so, of course, to the extent that there are transportation costs, that's going to interfere with this whole argument. However, Sophia brought up the idea of inflation. And remember, the argument here is about prices of goods equalizing, and we need there to be an imbalance in prices of, I guess, lots and lots of goods in order for the argument to work. So what do we call it when the price of goods across the board start to rise altogether? It's inflation. So these arguments suggest another version of PPP focused on inflation, which is saying if you have inflation, well, what does it mean? It means all your goods are expensive, which means people don't want to buy them as much, which means they don't want to buy your currency, which means your currency does what? It loses value. So this version of PPP probably is a bit more sound. Now that we've worked our way through thinking about how what trade implies about exchange rates, let's then go to the data and check the key prediction of purchasing power parity. This prediction that when countries experience inflation, their currencies lose value. And let's do it in the following way, sorry. Imagine that we took data for various countries in various years and plotted a graph on one hand we have inflation rates, and on the other we have the loss in currency value over the same period of time. What would we expect to see if purchasing power parity is true, or this version of it? If a country experiences inflation rate of 1%, what would we expect its currency to do relative to some benchmark, that is, right? We would expect it to lose by 1%. Remember, all this is relative, right? If you take two countries, let's say United States and Japan, they both have the same inflation rate, then there's never any imbalance, right? So the United States inflation rate is faster, you'd expect the dollar to lose value. If the Japanese inflation rate is faster, PPP tells you the yen should lose value. Okay, so this is all relative to some benchmark. If the inflation rate relative to the benchmark were 6%, then what would we expect to see? We expect to see a loss of currency value of 6%. What am I tracing out? I'm tracing out the 45-degree line. So if purchasing power parity is true, we would expect to see a 45-degree line if I made that plot. So let's do it. Let's check out what happens if we take data on inflation rates and currency and plot it out. Here it is. Here is that graph. It's for selected places and selected periods of time, but that's okay. Does it look like a 45-degree line? It's pretty close, right? On the other hand, do you notice anything else about this graph? These inflation rates are crazy high, and these exchange rate changes as well. These are really, really huge numbers. Here is Peru around the time that I was saying that we had a fixed exchange, or tried to have a fixed exchange rate, I guess. No coincidence, that's around when I left. These are extreme cases, and you can understand, right? I mean, the title of this thing is Great Hyperinflations of the 20th Century. So in these extreme cases, it's not surprising maybe that purchasing power parity works. Here's another picture. This is exchange rate changes in inflation in selected countries over longer periods of time, from 65 to 85. Why did I pick those years? It's because I wanted to have a lot of major currencies that were widely traded around the world. And what happens is, after this period, the euro was created, and a lot of countries that used to have separate currencies, like France and Germany, suddenly had the euro. So we would have very few data points. Does this look like a 45-degree line over 20 years, inflation versus exchange rate depreciation? Kinda. But in my mind, down here, it doesn't really work. This looks to me more like a blob than a 45-degree line. So we're seeing that this seems to work if we're looking at extreme cases, or if we're looking over long periods of time. So last, I want to show you a case that's not extreme, and I'm not going to average over a long period of time. I'm just going to show you what the exchange rate looks like. This is the exchange rate. This is the pounds per dollar, where the pound is the United Kingdom pound sterling. Okay. The blue line is the actual exchange rate. It's like an annual average. You can see it goes up and down and up and down and up and down. The red line, starting from 1977, is telling us what would purchasing power parity predict the exchange rate should do. So if it's going up, it means the dollar is gaining value, or the dollar should be gaining value, which means inflation must have been higher in the UK than in the US. When it goes down, it means the US dollar is losing value, or should be losing value, according to PPP, which means inflation was higher in the United States. Do these two lines look alike? Sort of yes, sort of no, right? They never really get too far apart. Or rather, let's put it another way. They sometimes do wander apart. Let's say here in 84, the actual exchange rate is 85. PPP says it should have been about 60. Sorry, 85%. It should have been about 60%. But then it comes back, overshoots, never really goes too far away, right? So it's almost like PPP is a useful predictor of exchange rates over a very long period of time, but certainly year to year, month to month, day to day, it's not useful. So that's how people generally view exchange rates. Sorry, purchasing power parity. So the conclusion is PPP works, but takes years. except, of course, for extreme cases, like the hyperinflations we looked at before. What does that mean? It means that other factors must matter in the short run. And of course, the factors that matter in the short run must be what? What we discussed earlier. The possibility of buying Japanese shares, or the possibility of buying Japanese bonds. That said, it doesn't mean that PPP isn't useful, because again, it does predict exchange rates over a long enough time frame. So you could use PPP to predict exchange rates, let's say next year or something like that. So in fact, if you've heard of The Economist magazine, it's a magazine about economics, and they have a research unit. And one of the things that their research unit does is make jokes. So what they did is they thought, what would be a good object that I can find everywhere in the world that we might use as a way of predicting exchange rates using purchasing power parity? Does anybody know what they use? The Big Mac, exactly. So The Economist magazine has a Big Mac index. And what they do is they see if the price of Big Macs rises in Tokyo compared to the price of a Big Mac in New York, then they'll say, okay, this tells us inflation is higher in Japan, so we expect the yen to lose value over the next year. Or if the price in Big Macs in London drops relative to the price of Big Macs in Paris, then they'll say, okay, that means inflation is higher in France, and so we expect the euro to lose value. And every few months they publish what their index is predicting, and it doesn't do a terribly bad job actually as a predictor of what exchange rates are going to do. So that's the Big Mac index. British humor, I guess. Let's go. Ready? First question, what makes options in general more valuable? Is it volatility? Is it high interest rates? Is it low interest rates? Or is it high stock prices? Very good, most of you got that right. That's from the options worksheets. Please review it if you got that wrong. Question 2, what does VIX measure? Interest rates, rates of return on shares, volatility, or liquidity? Someone thinking hard there? Very good, everyone got it right. That's good to know. TJ is taking the lead. Question 3, the exchange rate between two currencies right now is called what? The forward rate, the spot rates, the straddle rates, or the strike rates? All right. Remember, it's two currencies right now, so it's on the spot. Marshall is ahead. Question 4, purchasing power parity is the idea that exchange rates should equalize what? Interest rates, cost of goods, stock returns, or inflation rates? Cost of goods, very good. That's a tricky one. Most of you got it right. Question 5, if a Big Mac in Tokyo costs 399 yen and it costs 399 in DC, what does PPP tell us the exchange rate should be? Or what does The Economist magazine tell us? Very good. And last but not least, PPP affects exchange rates slowly, and what does this suggest about exchange rates? They have nothing to do with PPP. They're related to multiple factors. They're related to stock returns or they're related to bond rates? Okay, everyone got that right. That's gratifying. Let's see how we did. Third place is Alexandra C. Good job. Second place is Sophia. Good job. And first place we have Marshall. All right. So, Marshall, what awful thing do you want to do to me on Snapchats?
I like to put a hat on your head.
What?
Some sort
Cat
of
on my head, do you say?
Some sort of hat?
Oh, hat. I heard cat. There is a filter to put cats on my head. But let me look for hats. The cowgirl hat.
That looks good.
That looks good.
That looks awesome. All right. Thanks very much, everyone, for coming. I hope... oops, that's better. Can you see it now? Yeah. Excellent. Thanks very much for coming. I hope you learned something. Please feel free to get hold of me if you wish. Otherwise, I'll see you next week. All right. Take care.